I think you guys, some of you guys already know this, but I wanted to show you just what closing costs look like without really even doing much. Sometimes I'll tell somebody we need 10,000, an agent, we need 10,000 in closing costs. And they'll say, why so much closing costs? And I just wanted to show you how this works because it's not very hard to hit $10,000 in closing costs. So just the escrow account on this particular transaction. So this one is, the sales price is $585. Okay. And these people were putting 5% down. Okay. The escrow account on this one was about $4,300. None of these fees right here under these says estimated prepaid items and reserves for escrow. None of those are anything that we're charging the client, but they need to come up with $4,300 just for this account. So what you have is you have a year's worth of homeowners insurance. You have 10 days of prepaid interest through the end of the month that they're closing in. So if they were closing on, let's say, August 21st, we would collect about 10 days of prepaid interest through the end of that month. We're collecting 5 months of property taxes on this one. And then there's also a 2-month homeowners insurance cushion. So all of this is getting preloaded into the escrow account at closing. So even if we had zero closing costs and the title company charged nothing and the appraiser charged nothing, nobody had any cost for anything, you still need $4,300 just to pay property taxes, homeowners insurance, and some interest. Over here on the left-hand side are closing costs, which closing costs are really made up mostly of third-party fees. So you have the loan discount fee on this one, and that's to buy the interest rate down. You don't always have a loan discount fee, but on this one, it looks like there was 1 point. You can see, and 1 point for anybody that doesn't know means 1% of the loan amount they're paying to get this interest rate. On this one, at the time, it was 5.125. They paid 1 point. And you can see the loan amount's $567,450. And so $56,7450 is 1% of the loan amount. Then you have a processing fee, an underwriting fee. These are our fees, and this is what we charge on every loan across the board, and that's to pay the processors, underwriters, the whole processing team. This is where that money goes towards. Then we have an appraisal fee, $950. That goes to the appraiser. Doesn't go to us. Then there's a credit report fee, $192 on this one. That goes to a third-party credit reporting company that we pull credit with. Then you have a loan doc prep fee. That's a charge from escrow. Then you have the title escrow settlement closing fee. On this particular transaction, the escrow company was charging $14.56 and 18 cents. And that has to do with that fee will change depending on what the sales price is. So if this was $1 million price point, this might be $2,300 or something. This actually is a little bit high from what we're used to seeing on this price point, under 600,000 at $14.56. But anyways, this fee is a third-party fee charged by the escrow company. And then there's a title insurance fee, $927.81. This is the title company insuring the title of the property, that there's no liens or infringements on the home or on the title of the property. And then we have a recording fee with the county. That's the county charging a fee to record this transaction. And then this particular home, there was a homeowners association, and there was a fee to transfer from the previous homeowner to the new homeowner of $150. And then we have a title owner's title policy. Owner's title policy. This is also the title insurance company. This $1,715. If you scroll down, you'll see right above the yellow line, there's a seller title insurance credit of $1,715. So the seller, it's customary in Washington State for the seller to pay the owner's title policy. The reason it shows as a buyer's closing cost is because it technically is a buyer's closing cost, But in Washington state, I'm going to say 99.9% of the time, the seller pays this owner's title policy. Sometimes you'll see on new construction, a builder will not pay for it. That's kind of the one exception where I'll see where the seller is not paying for the owner's title policy, but 99 plus times out of 100, the seller will pay the owner's title policy. So
is that's not anything that, I mean, could we put in there that we would pay it if it made it that much sweeter on the buyer side?
you could, that would be something. I mean, I'd probably look for other things to not confuse it. Like I just, offer them that much more money for the house or something,
Right. Sure.
Yeah. Because it might confuse them, I would think. So anyways, this particular transaction, there's only 1 point origination, which that's honestly, that's how, like when you see rates quoted, like with banks, like online or mortgage companies, they're usually at least quoting with 1 discount point, which this one has 1 point. And so just with 1 point, you're looking at 13,127, but you can really subtract this 1,700 number. So you're talking about 11,000, whatever that is, $11,400 or something like that is what the actual closing costs are on this one. But then you also have this escrow account that you have to add in. And now you need at least $15,000 on this one of seller credit to pay for this person's closing costs in their escrow account. Now, this is just like a regular permanent buy down, and you could buy the rate down a lot more, and you could really start spending a lot of money on this loan discount fee. But I just wanted to kind of go over with you guys what it looks like what your buyers see for closing cost. And really most of these are either third-party cost or they're the buyer just setting aside money to pay their taxes and insurance and some interest. The fees that are our company's fees on this particular transaction are the $5,600, the $700, and the $695. The rest of this is all third party or them setting money aside in their escrow account. And then, you can see on this particular one, you have a sales price of $585 plus the closing cost plus the prepaid escrow account means that they owe $602,425 to buy this house plus pay the closing costs in the escrow. They're borrowing $567 that goes towards that $602. They've deposited $10,000 earnest money. And then there's that seller title insurance credit of $1,715, which means they have a balance left at closing of $23,260. And on the far right here is a breakdown of what their mortgage payment looked like. But this is what they see. So this is a pretty standard loan estimate or cost analysis worksheet. This is a cost analysis worksheet is just a simpler breakdown of the numbers of what they would see on a loan estimate. Okay, so I'm going to show you guys a buy down, and I won't. Yeah, this might look familiar to somebody in here, but the names and all that have been redacted here. But on this particular one, this is a buy down, temporary buy down, sorry, where we did a 2-1 buy down. The note rate on this one was 4.375%. Okay. This is a 10% down payment. So they borrowed $499,500. Okay. The temporary buy down fee to do this 2-1 buy down was $10,000. The 2-1 buy down again means I'm going to show you something. The 2-1 buy down means in year 1, they're paying 2% below the note rate. And in year 2, they're paying 1% below the note rate. And then in years 3 through 30, they're paying 4.375. Okay.
That's great.
What's that?
That's great.
Yeah, no, it's really cool because in year 1, they saved $552 a month on their monthly payment. If they would have taken, and they paid $10,000 to do this. So if they paid $10,000 down on their mortgage, that only drops the payment maybe $60 a month if they put $10,000 more down payment down. If they took $10,000 and they wanted to buy down the interest rate permanently, they might save themselves $150 a month or something over the, every month for the life of the loan. But somebody that you have that, they're projected to make more money in the future, or maybe they're having payment shock and they're feeling like, geez, this is just, this payment's too much. This is a nice way that someone can graduate into their payments. And it's a very conservative loan. It's just a 30-year fixed mortgage. So they're not doing anything risky. This isn't an ARM, but it does allow them to slowly ease into their payments. So in year 1, 2.375, year 2, 3.375, years 3 through 30. So this says payment numbers 25 through 360. They're paying the 4.375 rate.
Yeah, so this isn't like some weird ARM where the rate then balloons out of control after that first and second year. So that's just the standard rate. And did we have to did that rate get bought down a point, or was that just like the standard rate at that time?
Yeah, so there was a loan discount fee of only $624. So it looks like they paid an eighth of a point to get the 4.375 interest rate, and then they paid $10,000 to do the temporary buy down. So it was almost 0 points for them to get the 4.375 note rate, which that's their rate for 30 years. And then they paid that $10,000 up front to do this thing here, where you get the 2.375, then 3.375.
What was so is this their payment? It says borrower's portion of principal and interest. Okay. And so then it adjusts to 2,500 basically at the end of it.
Well, yeah. So the payment is the payment, but what happens is this $10,000 here that was paid up front gets used to subsidize these payments. So in year 1, it's subsidized, it's taken $552, but the borrower's portion of the payment's only $1,941. There's no real magic that's happening here. They're paying for it up front with this $10,000, but it's a nice tool to, sometimes people will want to put more money down on the house to save money on the monthly payment. That doesn't really do a whole lot. $10,000 financed over 30 years cost about $55 a month. But if you take that $10,000 and do this temporary buy down, it's saving them $552 in year 1. But then eventually, years 3 through 30, they'll just pay that regular $24.93 payment. But the thing is a lot of people that we work with are projected to make more money in a few years than they make today. I would think most people hope to make more money down the road than they're making currently, And a lot of people
the real beauty of that is if we can get the seller to pay it, right?
Yeah, And so you can see on this size of a loan here, it's basically a $500,000 loan. This $10,000 is not too tough to get from a seller, I would think, on a property that's been listed for a little while. But on this particular one, if you were asking the seller to pay for all of your buyer's closing costs and prepaid expenses, you're talking about, so this one was $17,000, and then there's a seller credit to offset that owner's title policy. So really, this was about $15,500 in closing costs, plus the escrow account was about $4,000. So you would need to ask your seller for, if we wanted to round up, just ask them for $20,000 seller credit, and you can really do some cool stuff like this, and help your buyer have a nice payment. This payment here on the bottom right, this is not so really in year 1, the borrower's payments $3,081 minus this $552. So roughly it's about $2,500 and change would be your client's payment in year 1.
Yeah, that's a nice little monthly payment. That's easy, right?
Yeah, I mean, you would think, I always use these condos that are on, or apartments that are on 164th here in Linwood. People pay close to that much money for a 2-bedroom apartment on 164th.
The Wildwood, yeah, the Wildwoods, they do, right? It's like $450 to $500.
I don't know.
Yeah, I know exactly what you're talking about.
Yeah, there's some newer ones that people pay a pretty penny for.
For that monthly.
We just talked about that, those new Alderwood ones. Terry, what was that? His son is looking at some crazy number.
Like 3,200 for a 3-bedroom.
Yeah.
3,200.
Yeah.
In Linwood, bro.
Yeah.
Crazy.
Yeah, that's a $600,000 plus house.
But then there's also that other, like another one that was like $6,000.
In that
In
same
Linwood,
complex?
and then there's like a few in Edmonds too.
Oh,
$6,000.
yeah. So anyways, I wanted to show you kind of what a temporary buy down looks like. And here's the thing, I did one of these type of classes for this Linwood John L. Scott office too. And what I was telling them is if you have a client that has a pre-approval letter from another lender, it doesn't really mean that much, because the deal is, let me show you this other flyer that this is, don't worry that this, I don't know if you can read, but this was named 2-1 buy down, but it's not. I don't know why it says that. This is a flyer we were making for somebody. It says the easy way to save money on your mortgage. It says with a seller credit, have the same payment as an $800,000 house. So this one was a $900,000 sales price, 20% down. And we showed how now this is just the principal and interest, but we showed with using a $20,000 credit, we can buy the interest rate from 5.5 down to 4.5%. Well, that saved, gosh, that doesn't actually, I'd have to take a look here and make sure that math works. This says a $700 difference in payment. Let me just get my calculator real quick, because Leah made this one and I feel like that payment's off. But the bottom line is we did the math on it, and a 20% or $20,000 seller credit with 20% down on this house, it gave us a payment when we use that seller credit similar to that of an $800,000 house. So if your client has a pre-approval letter that says they can only qualify for, say, 830, okay, with 20% down, well, you could be looking at $900,000 houses. They could qualify for a $900,000 house here. You just got to get a seller credit to help you buy down the rate, and all of a sudden your $830,000 pre-approval letter person is buying a $900,000 house.
And that's basically because it's a debt to income ratio that meets it's under because of that buy down.
What's that?
Is that because the debt to income ratio is under what they would have to afford with that buy down on a monthly basis?
Yeah. So like, let's say that they could only qualify for, let's say it was a $3,500 payment, and the payment on a, normal $900,000 house was going to be $4,900 or something, or $5,000. If we can use a seller credit, we can get them under that $4,500 number, and all of a sudden they're buying a $900,000 house. Where, if you just look at it at surface level, with what they can qualify for, they're maxed out at, like, let's say 830 or 820 or something like that, because they can only go up to about 4,500 based on their income. But we can do, in this market, it's like we can do crazy things like with like these seller credits. Like we can do some really fun stuff and help people buy houses that they wouldn't even think that they'd be able to afford with these seller credits. So that's what I was telling the agents in this office, is like your pre-approval letters don't mean very much, like, because we can go much, much higher if we have a seller credit than what your letter says. So that's where it's like these seller credits, it can be a real win-win for both the buyer and the seller. You can attract way more buyers, or way more buyers can qualify for your home with a seller credit than you just lowering your price $20,000.
So
I mean, it's hard to it's kind of hard to market that, I would think, but I'm just saying, if you guys have pre-approval letters, the number that's on there is not set in stone, because we have seller credits that we can play with.
So
And seller's credit.
essentially, like then, so a strategy for us, if we're working with a buyer, we're gonna kick up the price range that our client asked about. And we're gonna kind of like prepare them in two ways, right? So they're gonna say, hey, Jason, that's higher than what I said. And I'm gonna explain to them, okay, well, here's the deal. If we can find something that's been on the market 7, 8, 10 days, 14 days, a month, then the possibility of us negotiating you a seller credit increases, and then maybe I can get you enough money to get a point buy down, in which case your payment will be the same on this than what it was, and if not, if you really want to go for the stuff that's fresh coming on the market, then just make sure you're looking at the price range that your pre-approval letter says.
Yeah,
right?
yeah. But yeah, I mean, I'm seeing agents offering $30,000, $40,000 to buy down interest rate, or they're lowering. I mean, you guys have probably had some of these where I've seen people lowering their price by $100,000. It's like, you could lower at 50, do a $50,000 seller credit towards buying the rate down, and there's some stuff that you can do where you can really, do some fun stuff as far as buying down rates and helping people qualify that wouldn't normally be able to qualify for that property. So it's like, that's what I'm saying. It's like in the market that we had, I don't know, for however many years it was before this market that we're in now, the pendulum was on the side of the sellers. Now it's on the side of the buyers, and we can do all kinds of crazy stuff like, get big seller credits, and rates have already come back down quite a bit. So it's kind of like, man, it's a nice sweet spot if you're a buyer, especially if you can get a seller credit. You can, do one of these temp buy downs, or you can buy down a rate into the low to mid 4s. So in low to mid 4s, even where we're at in the low 5s right now, this flyer is a little bit old. So that 5.5 rate's a little higher than what the rates are, but you can these rates that we have right now, if you looked at a chart over the last 50 years, we are at the bottom almost. Like the chart would look like this. It went down to where, like, during COVID, we were even below 3%. And then it's a little pop right here. This is where we are. But if you looked at the chart, it's like this. Here's where we are, So the interest rates are still really good. And if you can get a big seller credit to buy it down further, and you're getting a price that's maybe 20+% less than what they would have paid in, say, January, it's a pretty good deal for your buyer. I think I've been saying this almost like, right now is the best time that we've had this whole year to be a buyer. The prices are down, the rates are down. And you've heard that saying that I'm tired of hearing, where people are saying, marry the house and date the rate. But that is true though, because they say the people that I follow, as far as interest rates go and what their forecast is once this inflation gets under control, these mortgage rates will come back a little bit for us. So there's a good chance, if you have somebody that buys a house right now within the next couple of years, I don't want to guarantee it, and I tell people this, but I'm letting people know that the forecast is actually for these rates to come back once we get this inflation under control. But there's a good chance you'll be able to refinance. So if you really like this house, you're getting 20-30% off of it versus what you would have paid 4 or 5 months ago. I mean, what do you want? Anybody that's been waiting, this is a good time.
So question, do you know the answer to this? I'm sure you have a rough guesstimate anyway. Let's say we're at a roughly, an $800,000, $750,000 house, sort of a, more of a median price in our area. And let's say I had, 15,000 or whatever over at what year does it make, do I actually save more money by using that money to buy the rate down permanently versus temporarily. So if I'm a more play it safe kind of person and I know I'm going to be in the house 5 years, 7 years, what do you think roughly on that?
Yeah, there's a lot of variables here. So if you're going to be in the house 5 to 7 years, as long as your break even on the permanent buy down, is within, less time than, less time than when you think you're going to be out of the house. I don't think it's a bad move to do a permanent buy down. If a break even's 4 years down the road on a permanent buy down and you think you're going to be about 7 years, that's not a bad move if somebody wants to do that. The temporary buy down, I would say it's hard to even compare the temporary buy down with a permanent buy down, because you're not really, all you're doing on the temporary buy down, it's a tool to help you lower your monthly payment, and have be able to sleep at night, let's just put it that way, and have a lower monthly payment and slowly graduate into your full monthly payment. Whereas that permanent buy down, you're actually spending, you're paying a fee to buy down the interest rate permanently. It's hard for me to compare them because they're two different things. In your situation, Jason, I mean, I would say that you can't go wrong with a permanent buy down that breaks even before you're going to sell. If somebody not the temporary buy down is not for everybody. Not everybody like sees the value in that. But it just depends how important it is for you to have that payment relief in the first couple of years. So
sure, and I get it, and I if I'm thinking, and some people are a little riskier, and they're like, okay, or I just really am confident that I am going to grow. If I'm a younger person, like, yeah, my income's going to grow, or yes, I'm pretty confident the rates will go down and I can refinance, then sure, I'm going to do that temporary buy down. But if I'm sort of like middle of the road, I'm like, I don't know if I really buy all that. Maybe I just like that 30-year guaranteed lower rate. So I'm just kind of curious at what point financially it makes more sense. But I suppose it's more of a mindset thing probably anyway. So
I feel like it's more of a mindset thing than what makes the best financial sense. I think that they both make sense. And you can't go wrong doing either one. So, but where you could go wrong is if you spend a bunch of money on something that had like a 4 or 5 year break even, and interest rates come back in 2 years or a year, and you spend all this money and you never hit your break even point, then you wasted some money. So it's kind of a tough one. I would lean more towards paying less points if you can, being that, supposedly, and we can't guarantee this, the rates will come back here in a couple of years.